So let's start the discussion. Starting at the beginning, can you give a general overview of the core terms of seeding a private equity or private credit GP and how and why that deal is differentiated from a traditional anchor investment?
Sure. So I'd first make the distinction between anchor and seeding. Typically anchor, there's some sort of discounted fee arrangement, but the seed relationship is typically an economic sharing of the growth of the business in some form. So first distinction, discounted fees versus economic sharing in the business. And then in terms of the anchor terms, the hedge fund or liquid side of the market is much more robust. There's a lot more data points. It's very commonplace. It's really occurred for the past 40 years. So there you'll typically see something around $100 million anchor check for 20% of top line revenue. Once you move to the private side, it's a lot more nascent of an industry, partly because the scarcity of capital for the seeder itself and obviously the underlying founder is just that much more difficult to find. So think of your typical LP out there raising money in private markets, particularly in this environment, is very challenging, exponentially so for the seeder as well. So because of the scarcity of capital and the lack of deals that are out there, you see terms that vary quite widely across the map. So I'll maybe pause there and pass it over to Cesar, who spent some time on the private credit side as well.
Yeah, that's mostly what we've been focused, in part because we like the pairing of an underlying investment that has good downside protection, right, which a credit fund should have, versus a more kind of volatile equity fund, if you will, with the sort of cheap call option you're trying to create with the rev share. Those two things together work well. But to piggyback off of Chris's point, in the private credit space, we found it's very bespoke, right? So are you coming to the table with a $300 million seeding check, a $50 million seeding check? Are you doing it yourself? Is it a club deal? How bad does the counterparty need the money, right? There's a certain level where I think it doesn't make sense to extract as much as you can, because if you get above a threshold of, 25-30% of owning the manager's economics, it starts to feel like they're not that independent, and you don't want that either, right? So you're always trying to strike the right balance where everybody's happy and has enough alignment and upside.
And I would add to that, on the private side, because those businesses are more costly to start, bigger teams, you have to build origination, things like that. And typically the costs associated with the base infrastructure is incrementally higher, that the seeding relationships are pretty flexible. There's a lot of bespoke custom solutions to find a way to back that founder and let them grow their business. The goal is not to choke off growth, but to really support it and nurture it.
And one example of that we've deployed is, hey, the dollar today and for the first couple of years is very important to you. So maybe we'll give you a holiday on, when the rev share kicks in or something, and trade that for some back end. So if it works well, we're both making more money, right? So you need to be kind of creative, thinking about the life cycle of the firm.
Yeah, and there's a couple other terms that are out there. So holidays on the rev share for a period of time, base budgets, so maybe sharing incrementally above a certain threshold, helping with the GP sponsor commit, which, from the seeder's perspective, a dollar is fungible. That could go in as an LP check. It could go in as a GP commit. Could go into OpCo, working capital. So finding a way to be flexible with that is something we found works quite well in the private space.